Hello, I'm Richard Bollamorris at Newscape Capital Group, and this is our market outlook at the end of a volatile August. In the last few weeks, we have seen a general rise in risk aversion and a decrease in equity indices across the globe. But our opinion remains that markets are yet to reflect the real economic outlook for the US, Europe and the UK. Focusing on the UK, since the highs of April, the FTSE 100 is down some 15%, and some are suggesting this could be a very opportunistic time to increase your equity exposure. This may be true for the long-term brave investor, but on balance, we expect things to get worse, therefore cheaper, before they get better. And our wish to protect investors from loss over all time periods prompts us to maintain our cautious stance. As the government's austerity measures begin to bite, the private sector is being hit by slowing retail spending, rising unemployment and falling consumer and business confidence. Most economists expect growth to remain just about positive, but like the 0.2% growth in the second quarter this year, this doesn't look sufficient to generate the near 20% growth in earnings predicted by many analysts. Globally, much was expected from Bernanke, the Federal Reserve Chairman, in a speech he made at Jackson Hole last Friday. But his inability to announce anything new is indicative of the situation many central banks and governments find themselves in today. Having dropped interest rates to around zero for the last 2 years, having cut taxes and increased spending, and now that having to be reversed, it is unclear what is left in what Bernanke claimed to be tools appropriate to promote stronger economic recovery. The market will no doubt keenly await the extended Federal Reserve meeting in September, but the reality remains that a significant challenge lies ahead. With economic growth looking weak at best, and with the ongoing risk of sovereign bankruptcy in Europe, we are continuing an underweight position across all risky assets going into September.